Hey guys, it's Downtown Josh Brown, back with your regularly scheduled episode of What Are Your Thoughts? Happy Tuesday. I'm here with Michael Batnick as usual. We're going to go through some of the biggest topics on Wall Street this week. Hope you enjoyed the show. Let's get right into it. Okay, I wanted to ask you about the Corona correction. I feel like it's a pretty big story. So I would just say it's still going to be a V-shaped recovery, but the V now stands for vaccine. The president's chief of staff over the weekend, either accidentally or on purpose, was basically like, we're not going to control this thing. And it looks like they're playing for either herd immunity or a vaccine, whichever comes first. And they're really not going to do much more beyond that. So we're on our own. New record daily infections over the weekend, all over the country, cities, rural, and now stocks have to go back to the basics of what works in this environment and what doesn't.
What do you mean stocks have to go back to basics? Wait, stocks have to go back to basics? I have a lot of questions, but what do you mean stocks have to go back to basics?
The greenest stock on my screen yesterday was Zoom. What else do you need to know? Followed by Citrix, followed by everything else that involves working out of your living room.
First of all, I feel like it was more of a Corona crash than a Corona correction.
Fine, take it.
But what exactly is the question?
We probably have to revert back all of the bullishness about small caps starting to break out relative to large caps, cyclicals and values starting to outperform tech. Like all of that has to get unwound.
Hang on. Why?
Okay. Because it's a huge stumbling block in the reopening of the economy. People got a little too excited, and now we're retracing. All of the gains that we made in flattening the curve are vanishing. We're making new daily records in hospitalizations.
But why are you tying the stock market directly to the virus? The stock market hasn't been doing that for months.
I'm looking internally, and it looks like we're seeing a reversal. I mean, it's
yesterday. Hold on. So last week, very prematurely, apparently, I think on Thursday or Friday, I wrote about this. The mean reversion that we've been seeing in the reopening trade.
Oh, is that why you're so prickly about it? Go on.
Macy's, Marriott, cruises, airlines, casinos, etc. Versus
I hope you loaded up. I hope you loaded up on Macy's for the Corona crash.
And so that was looking relatively decent until Monday. And yesterday, it just absolutely fell through the floor, fell through the everything. So it's one day. We'll see what happens today. I don't know. I don't know that the mean reversion is completely over. We'll see.
Large cap tech, actually, relative to the S&P 500, my friend John Roque was writing about this. Large cap tech all peaked relative to the S&P 500 in July, August, and September. So it's really been almost 8 weeks since those stocks were doing better than the overall market. The Microsofts, the Googles, the Apples. So it really did feel like you were getting this rotation finally, and that the value and the industrials and the cyclicals were going to rip into the end of the year. And days like yesterday remind you, it's not over.
I think yesterday was a really nasty shakeout, and I do believe in the reflation trade. We'll see.
I hope so, and I wouldn't throw in the towel on it, but I feel like everyone started to get into that side of the boat. And
agree.
The infection rate is just, and it's not just the U.S., it's Europe too, and they're doing better with testing and tracing and masks than we are allegedly, and it's not even helping. So that's why I feel like it's vaccine or nothing for like 2/3 of the stock market. What do you got?
Okay. If you had to pick one business that was going to be most blown up by Amazon and e-commerce, I don't know about you. For me, it probably would have been Best Buy. That was right in the crosshairs. Remember, there was this whole thing about what was it called? Showcasing, how people would go to Best Buy and then go home and buy whatever on Amazon. Yeah. So Best Buy, the stock is at an all-time high. Its revenue is a little bit off of its all-time high, but its free cash flow is at an all-time high. Its net income is at an all-time high. Go figure. Who saw that one coming?
Well, I think it probably wouldn't have worked out this way if not for the Corona-related housing boom we're having this year. So you know Logan Motoshami was on my podcast. He was saying we were going to have a housing boom regardless, and the pandemic just sped it up, which maybe he's right. But we really did end up with a situation this year where everyone said, oh, no movie theaters, no bowling alleys, no bars, no nightclubs, no restaurants. Okay, I'm going to get the biggest TV I can find. I might actually buy 3 of them, one for each room. So
you think it's that simple? I mean, you might be right.
I really do. I really do.
Look at this chart. Look at this chart of Best Buy's free cash flow. I mean, pretty much, range bound, whatever. Hasn't seen much progress and absolutely went vertical.
Do you think that happens without a pandemic? No.
No, I think you're right.
Okay. And as proof, look at some of the sporting goods companies that still exist. I don't know. There's probably 2 or 3 of them left.
Dick's.
They all went vertical.
This confused the hell out of me. So Dick's was 50 in December, January, whatever. Crashed to 13. Okay, that made sense. It's a department store shut down. But now it's at 63. So it's in a better position now than it was to start the year. How?
Because everybody bought exercise clothes and everybody bought sporting goods to keep their kids occupied. These things are not complex. So I don't think that this is really a story about the triumph of e-commerce at Dick's Sporting Goods or Best Buy, although they're both doing this very well, I would point out. But, these are categories that were absolutely being demolished by Amazon. A lot of their competitors went under. Best Buy used to have 5 competitors. They're the only one. Dick's Sporting Goods used to have, like, the Sports Authority was around and Modell's, and they're all gone. So I feel like the best companies in their respective category made a lot of investments into omnichannel. They're doing it well, and it's not really that much more complex. There's only one left in each category.
All right.
So
you had a take that I don't remember where you said this, that you're not a fan of buy on your mobile. I don't know why I said mobile. Buy on the app and pick it up in the store. I love doing that. Home Depot, for example.
It's BOPIS. Buy online, pick up in store. Nah.
I'm a big fan.
Can I tell you a funny story?
What's wrong with it?
So I bought the Nugget a PlayStation. He already has an Xbox. For some reason, he needed a PlayStation also. I managed to find one in a Target. Picture me, first of all,
Dude, I do Target pickups. I do Target pickups 3 days a week.
Picture me going to Target. Anyway, maybe it's just me. I buy the thing online. It says it's ready in 3 hours for pickup.
Yeah.
But it's the Nugget, and he wants it now. So we drive over to Target, which is 20 minutes from my house, and I walk in. I present the online thing on my phone to the lady that's at that counter for online pickup. She's like, "Oh yeah, come back."
You physically go into the store? You do curbside. They bring it to your car.
But you're missing it. I'm not waiting 3 hours. I'm not waiting 3 hours. I walk into the store. God. I say, I bought this online 20 minutes ago. May I please have it? Like, can you send somebody to back and go get it? She goes, no, it doesn't work that way. Why? I paid
it doesn't work that way. It doesn't work that way. You have to wait 3 hours. Big freaking deal.
No, I don't wait. So that's my problem. That's why I'm not into it.
All right, get lost.
Capiche?
I guess. Go ahead.
Can I pitch you a stock?
Please.
All right. General Motors. I bought some for the first time in my life. I have this idea that GM is actually a growth technology stock that is unfortunately wrapped inside the cocoon of a value industrial stock. GM, I don't know if you know this, is the first company to get approval to operate an autonomous robo-taxi service in a major U.S. city. Starting in
so you
San
would have
Francisco.
Thought that would be Tesla, Uber, or Lyft, obviously, or Google.
They crushed them. It's called Cruise, and
I'm saying you would never think that. That's news to me. I would never think that GM would get approval before any of the other electric companies.
That's my point. So if you're an analyst that covers GM, you're probably aware of this, but I don't think a casual stock market participant has any idea. But Cruise is going to start in San Francisco. San Francisco is a tough terrain city to operate an autonomous car. The only comparison is Waymo, which is Alphabet. They're operating in the suburbs of Phoenix. But if you've ever been to the suburbs of Phoenix, those streets were like carved out with an X-Acto knife. They're perfectly parallel and perpendicular to each other, like perfect squares. There's no weather. It's literally the same weather every day. There's no rainstorms. There are no bridges.
Stock looks good.
Yeah, so GM is ahead of Tesla in self-driving and ahead of Alphabet. That's a surprise.
Hold on, two things surprised me. I mean, 50. It's still a $50 billion market cap. I would have thought it was probably half of that.
I think Ford is now much smaller, but GM has a little bit of a premium baked into its valuation because of some of these developments, but I would argue it could be more. So they have the electric Hummer rollout starting in 21. Did you see it?
How much is
online?
that going to be? Yeah, how much is that going to be? I saw it's super expensive.
Yeah, it's not meant to. It's not like an everyday car for most people. It's luxury, but that is going to compete with the Cybertruck, and they sold out the whole first year of production already. So now they're already taking orders for 2022, 2023. So they sold out 21. Now there was this idea that GM was going to spin out the electric vehicles and the autonomous vehicles into a standalone company that could be worth anywhere from $20 to $100 billion by itself if you value it the way they value Tesla and some of these new upstart.
Yeah, well, I guess it's possible. By the way, so GM and Tesla, so GM's $50 billion, Ford's $30 billion market cap. They were both the same size as Tesla in 2019, and that was like a big deal that Tesla was as big as them. And now Tesla's 398 compared to their combined 80.
Tesla's
Nuts.
a $400 billion market cap.
Yeah.
GM is ahead of them in autonomous, and they're launching a competitor to the Cybertruck next year. I don't really understand the valuation discount. This is not the same GM from prior to the bankruptcy, like in terms of indebtedness and union contracts and pension liability.
Question for you. Is this so right now the stock's at $35. Is this a trade? What if it goes to 25? Is this like going to be, are you thinking this is long term?
It's a trade. It's a
All right, so
trade.
if it rolls over, you're out?
I don't want to be like a long-term investor in GM,
Got
but
it. Okay.
I think they're going to start getting the benefit of what they've accomplished in autonomous and electric. And if they don't, I'll sell it. But
Okay.
I don't know. This to me seems like a really interesting situation.
Looks
Guys,
good.
we don't give financial advice on this show, so don't go trading stocks we talk about. We're not your financial advisor. All right, what do you got?
Well, no, that's why I asked, because if this doesn't work, you're out. So to that point, I want to talk about Bearish Billionaires. So Lindsay reminded me of this. He tweeted about it. This was back in April. Jeffrey Gundlach is shorting the market, says a retest of the low is very plausible. The market's up 22% since then. In May, Stanley Druckenmiller said the risk reward for equity is maybe as bad as I've ever seen it in my career. A day later, David Tepper said the stock market is the second most overvalued in history, with the exception of the tech bubble. And in no way, shape, or form am I dunking on these guys. They're the best investors of all time. I wasn't exactly a raging bull either. And then CD&E, I'm sure Druckenmiller changed his mind a day or two later. So, but that's the point, is that what do casual observers of financial media do who don't really understand the fact that these people aren't going to come on TV 2 days later and say, I changed my mind, it's all good. Like, they have the ability to flip their positions in 2 days, but I changed my mind is not necessarily as good a headline as this is the worst risk reward I've ever seen. So how do people navigate the best investors of all time all leaning on the same side? How is somebody supposed to say, I don't care what they say?
So Tepper and Druckenmiller are gut traders, and they're maybe two of the best that ever did it in like world history. So they will change their minds, and not only will they change their minds, but they'll take their allocations and like do a 180 from one direction to another, and nobody else can really do that, and nobody else moves with that level of certainty when they say, you know what, everything I said 2 days ago was wrong. This is what I now want to do. Like Druckenmiller's most famous trade was a result of doing that. And so, like, if you think you're David Tepper or you're Stanley Druckenmiller, you'll find out probably the hard way that you aren't. That's one. And number two, neither of them are actually doing this for investors anymore. They're both family office situations. So, like, they can. Here's the difference, Michael. If you launch a hedge fund and you start doing that shit, where you're like, I've never been this bullish on Tuesday, and on Thursday be like, you know what, we're actually going to get net short the market. If you did that with LPs, with clients, like you could maybe do that once. Can you do that 3 times? No, you obviously can't. But if you were managing your own money, you could do that every day of the week. Who's going to stop you? So
my point, my direct question is this: how are investors supposed to deal with these people, and it's never going away. It's permanent, right? The best investors of all time always come on TV and say things. How are investors not supposed to listen?
Oh, I don't know. Grow the up.
Come on,
Literally grow up. Did you watch Evel Knievel as a kid jump over 60 cars lined up and think?
I think that's being a little harsh.
He thinks I should do that.
That's being a little harsh. You and I know, but the average investor, the average person watching, doesn't.
Batnick, this is my whole brand. Don't tell me it's a little harsh. I'm telling you, your investment objectives are not the same as somebody that has $5 billion in the bank. Can you live with that reality? I mean, that's what I would tell people. Is he now cleaning the mic for you?
Next question.
All right. So I wanted to do this thing about hedge fund giants. The nice segue. I feel like this article at Bloomberg, hedge fund giants lose their appeal as havens in global turmoil. It's kind of an old lesson that gets relearned from time to time, but basically size is the enemy of performance. So Bloomberg is basically looking at hedge funds by size and noting that the largest ones, which make up almost all of the industry anyway, have underperformed during the corona pandemic, which was a period of time where their investors would have expected them to outperform, given that they spent the last 5 years complaining that there's no volatility. Well, here's volatility, and it didn't work out. But you're now talking about 10, 15, 20, $30 billion hedge funds. It's really hard for them to be nimble enough to capitalize in a year like this. The emerging hedge funds that they looked at did much better. I don't know why people have so much trouble with this. What do you think?
Well, I thought this article was a little bit unfair because to me the headline is Bridgewater and the Renaissance Institutional Equity Fund have had bad years. To me, that's the story. Buried in the article is not all large hedge funds disappointed. Multi-strat firms such as Citadel, Balyasny, and Millennium have done well. So it's not all large hedge funds have done poorly. Bridgewater and Renaissance's equity fund, which is not Medallion, have done poorly. Others have done well.
Right. So, but they're saying funds with $5 billion or more are 67% of the entire $3.1 trillion in assets.
Right.
So the majority of people invested in hedge funds are in the gigantic funds.
Correct.
Because that's the stuff that gets sold to them from the bank. So like if you're like a whatever family office, like a $25 million family office, or if you're a wealth management client at JP Morgan and you have 10% allocated to alternatives, what do you think they're giving you? They're giving you the $30 billion fund that's accepting fund-to-fund money, consultant money.
I guess
right?
Nobody gets fired for selling Bridgewater, but I would also just say that in fairness to hedge funds, I mean, this was a pretty wild year. I understand that they, generally speaking, want volatility, but this was a bit extreme. So I don't necessarily blame them for not seeing this or reacting fast enough.
No, I don't blame anyone. But two things I would throw at you though: when you're charging 2 and 20 and you're telling people that they should use a hedge fund because they're more capable of taking advantage of opportunity like this, then you have
not
to
every time.
You have to do it. You have to
listen, I get it. I believe me, I get it.
And if you're a $20 billion hedge fund, you're not really a hedge fund anymore. You're what's called an alternative asset manager. And that's something different. The original...
What's a hedge fund anyway? I mean, it's such a broad category. There's about, 300 different styles?
A hedge fund is a fund that's allegedly attempting to make money no matter what the environment is. I think that's the way investors picture them. They don't expect them to beat the stock market every year. They just expect them to grind out gains by playing both sides. And that's okay if that's not what you're doing. But I think that's why these articles get written. They're a little unfair.
Well, how about this? You tell financial media viewers to grow up. What about institutional investors grow up? You think that your hedge fund is going to be able to save the day every time?
No, I don't. I don't think anyone should. But I think when you have a year like this and you're invested in global macro funds and they don't get it right, you're just like, all right, well, if you don't get this right, then I don't understand what the goal is, like what the point is. I think there are people that feel that way.
Fair enough. All right, I want to talk about let's talk about Bitcoin. So PayPal made some big waves last week. They're now going to be launching a platform that allows users, merchants to exchange cryptocurrency. So there's a few things going on here. In the press release, according to a survey by Bank of International Settlements, 1 in 10 central banks representing approximately 1/5 of the world's population expect to issue their own digital currencies within the next 3 years. So I think that we are on the cusp of a lot of activity. JP Morgan, did you know that they have a digital currency called JPM coin?
Yeah, I'm living up in that. I own as much as I can.
So somebody from the bank said, using a version of the blockchain with the participants being the main issuers of checks and the main operators of lockboxes, it's possible that we can save 75% of the total cost for the industry today and make checks available in a matter of minutes, which you would like, Mr. Target Pickup, as opposed to days.
Yeah, I think the PayPal announcement's a big deal, and I don't get gassed about this stuff. I'm not like a disruption hippie or like a Bitcoin guy, but what I've been thinking, and who cares what I think, but what I've been thinking and saying is that until the consumer is using Bitcoin in a way that's so seamless that they don't even know they're using it, like just buying things in the real economy, until that's actually a thing that's happening, it's just always going to be this weird like Dungeons and Dragons world of like super intelligent people that understand it and everyone else who doesn't. So I think if PayPal can bring this to tens of millions of users who want to try it and they have a good experience, seamlessly moving dollars and Bitcoin interchangeably and actually transacting, I think that really could be a game changer. I think it's actually more important than the launch of futures in Chicago or any of the other milestones that we've seen. Like it's a given that speculators would feel more comfortable with the concept of cryptocurrency than consumers. But if you get consumers there, that's the start of something new.
So look at this chart of transactions per day. It's hasn't really picked up mass adoption. It's gone pretty much sideways since the spike into the winter of December 2017. Price is as high as it's been since the peak in December 2017. Matt Hogan did this great letter, and this is some of the impacts that he estimates could happen. Today, the largest crypto wallet, blockchain.com, has 50 million users. Coinbase has 40 million, Square has 30 million, Robinhood has 12 million. At nearly 200 million US users, PayPal is 4 times the size of the largest existing platform. So obviously, he says, we have no way to estimate the impact, what the adoption is going to be. But Hogan goes on to say, PayPal's smallest competitor, Square, which allows users to buy and sell Bitcoin through its Cash App, they've had significant flows. In 2020, in just the second quarter alone, Cash App users purchased $875 million of Bitcoin. So PayPal's user base is approximately 6x the size. If it's even half as successful as Cash App, we're talking about billions of dollars.
Yeah. So you know how like PayPal grew like wildfire in the recent era with Venmo? Like forget about early PayPal allowing you to transact on eBay. Like the growth of Venmo was about somebody sending money to someone who did not have a Venmo account, but they would send them a link, and you could use a regular person who had never heard of it would just click the link and it would say, create your Venmo account to get your money. If they do something like that with Bitcoin, where let's say you're my personal trainer and I send you $150, but I send it to you in Bitcoin, and you click a link and create on PayPal a Bitcoin account, and you get paid that way from me, and then there's an option, convert it to dollars immediately. That's your first experience with digital currency, and you're like, oh, that's no big deal. Now, here's where things get tricky. People will be less comfortable transacting in Bitcoin if the price volatility remains anywhere near where it has been in the past. So
not all people.
Not all people, but many people will not want to buy and sell because they don't want to end up with it at the time that it drops 10% in value.
Counterpoint. I agree with you. 100%. But counterpoint. I think that, so Hogan writes, PayPal could jumpstart the use of crypto in commerce. They have 26 million merchants on their platform. So I agree with you. Maybe people will be spooked by the price volatility. They don't want to get paid $10 today if it could be worth $8 tomorrow. I get it.
Right.
But I think that if this gains mass adoption, there's going to be relatively easy ways for big companies to hedge out the risk of Bitcoin or whatever crypto that they're doing.
So we're saying 26 million merchants. What percentage of those 26 million merchants have a currency hedging person standing by?
What if PayPal can do it for them?
Well, I don't think it'll be necessary. I think within the app, you'll be able to instantly convert. So
Okay.
you'll get paid in
Okay, good
Bitcoin
point.
and say, make this $1, make this dollars.
Right.
That's big. I'm agreeing.
True.
That's big.
One last point. I have no prediction on the future price of any of these cryptocurrencies, but I am definitely bullish on adoption, and I'm kind of excited to see what happens with governments getting involved and corporations getting involved and people. And I just think that this is going to be an exciting place.
If you're bullish on activity taking place in crypto, then I'm starting to think you might also have to be bullish de facto on price. And Mark Andreessen's been saying this for 10 years. If in fact it turns out that businesses and consumers pursue this kind of mass adoption in Bitcoin, let's just leave everything else out, just straight up Bitcoin. The market cap of Bitcoin, I know it's not really a market cap, but the total nominal dollar amount worth of Bitcoin that exists right now has to go up to accommodate the size transactions that will take place. So I used to say I could picture a scenario where Bitcoin becomes popular to use and trade and speculate with, but the price doesn't necessarily have to go up as a result of that. Andreessen's like, no, you don't understand. If you think that the amount of commerce that's going to take place in the thing is going to skyrocket, then the price has to go up. It has to go up because it's not big enough otherwise to accommodate all of that in and out, buy and sell traffic. So don't be shocked if PayPal adoption leads to a new high. I wouldn't be shocked. I never sold mine. So I'll look like less of an idiot if I keep holding it and that happens. All right, but we want to know what you guys think. But before we go hang on. We have a viewer question. Viewer question.
That's right.
Let's go to Duncan.
Hey guys. So today's seventh question comes from
What
Carter.
are you still sleep? You're still sleeping? You're in my time zone. Let's go. Brighten up, bright eyes.
Okay, so today's question comes from Carter, who asks, does paying a high dividend end up hurting the long-term growth and health of a company? And is it now best practice to avoid these stocks?
You think that's Carter Worth?
The technician?
Pretty exciting. That'd be pretty exciting. Does paying a dividend hurt long-term growth? Why? Because they're diverting. Mike, do you think they're asking because like they're diverting cash that could be spent on R&D or CapEx instead?
So if I understand the question correctly, it's should I avoid high dividend yielding stocks? And the general answer is you should be careful because no company wants to pay out 8% of their earnings to dividends. Nobody wants to have an 8% yield. Sometimes the payout ratio can be much higher than that. So in other words, if a company has a dividend yield of 3-4%, which is fairly healthy, but then the price gets destroyed and it jumps to 8, 9, 10%, yeah, that's a red flag. So when you see these stocks that are giving you 13% yield on your money and the 10-year is at 80 basis points, you should be incredibly skeptical. So can it hurt its future growth? Well, look what's happening with Exxon, for example, right? How much debt are they taking out to continue to pay out their dividends? So it certainly can.
There was a period of time in the 2000s decade when I was a young stockbroker where, let's say from 2004 to 2007, this was like a big fad, was shipping company stocks, like tankers. So these were either dry bulk shippers or these were companies moving oil between continents.
Who were they? What were some of the names? I forget.
They're all bankrupt. One of them, the ticker I think was Bulk.
DRYS.
Or DRYS, dry ships.
Right?
Yeah. A lot of them were named after Greek gods and stuff. A lot of them were based in Greece, but they had like a U.S. ticker symbol, right? Or it was a U.S. company domiciled in Greece.
Bankrupt.
Yeah, they're all gone. But I'm just saying they were paying out regularly 10 to 20% yields. What has he got? What is that?
Wrapping paper.
Nice. So we were pitching these stocks to clients and they were working and they were 10, 20%. But the reason they were all 10, 20% is because that's literally the only way they could attract equity capital. And it ends badly. They end up paying out all of their capital. They have to do secondary offerings. They have to dilute or they have to sell debt. And they'll sell debt and then use the proceeds to pay a dividend. It's insanity. So I agree with you. And I would also say these days, when you see a stock yielding 8%, it's probably because it just got cut in half. Like, and it got cut in half for a reason, not because the market is sloppy. So, all right, that's my take on that. But we love your feedback. We want to hear what you guys think. We love reacting. We love replying to you. Go ahead and smash that like button if you have not already. Tell a friend about the channel. Well, we are very, very happy to see the audience for the show growing. We want to keep doing it. So spread the word far and wide. We love you guys. We'll be back very soon.